Hello.
Hey.
Hey, everybody. Thank you for joining us today. Another Tuesday, another stock deep dive. How you doing today, Mr. Stoffel?
I'm doing pretty well. I'm curious to learn more about this company. Much like last week, I quizzed you. This company we're going to talk about is worth somewhere in the ballpark of $870 a piece. 1 year ago today, it was $78.
What? Quite the run. This is another
So-
company that is taking advantage of the short squeeze going on in the, I think it's a supplier to the AI industry, and has just seen, I'm guessing, explosive demand, life-changing financials, and the stock has reacted to all that positivity.
Again, I feel like we should set up a space for people who are owners of this, if they want to support our program, to send their small little donations, because, man, those are some returns.
Greeting, everybody. Thank you guys for joining us. Hello to everybody that is joining us in the chat. Today, we are going to be talking about this company here, Lumentum Holdings. Look at this stock chart. I'll just go full screen on this for a second. This is a stock that pretty much did nothing, absolutely nothing, and then in the last year has just gone parabolic. Look at that. So
It's an 11 bagger.
Kudos to you if you predicted that this was going to happen. I'll zoom in a little bit just so we can see. This is now a $65 billion company. Let us know in the chat. Is this a stock that you hold? Is this a stock that you own currently or is on your research list? Let us know. Let us know about that. Stoffel, while people are commenting, I would say just from the outset, given the little bit that I knew about this company, I'd rank this as kind of a 4 out of 6 on the how easy is this to research scale.
I'm willing to accept it might even be a little bit more to the right, but I'm going to withhold judgment till we find out more.
Yeah. Okay.
So far, we don't have anyone that's going to send us lots of money because nobody here owns it.
So anyway, curious people just like we are. Well, fair enough. So we're going to figure out, we're going to research this stock together over the next hour or so, figure out if this is a business that could be really worth putting on our radar, potentially buying, or is this just a company that's likely benefiting from the bubble that we see in AI, all things AI. So to research this company, we're going to go use the stock simplifier process, 7 steps that we go through one at a time to figure out, is this a company that is worth investing in? Now, step 1 is what phase of the business growth cycle is this company in? This is an important step to go through because it informs the rest of the analysis that we do. So this is where we like to start with which of the phases that it's in. Curious if you're watching this, would love to know what phase you think this company is currently in. While we're waiting for those to come in, I'm going to go over to Stock Simplifier. I'm going to enter the ticker symbol here, LITE. This is going to be Lumentum, a $67 billion market cap company. And this is what we got to figure out. So I'm going to go over to Stick Simplifier, some prompts that we have. We have a prompt here that figures out the phase that a company is in. I'm going to go ahead and put that into Gemini, and then Lumentum, LITE. If it's doing its job correctly, it should say what stock. There it is. So we're going to talk about Lumentum. LITE is the company.
So far, I'd say we've got everything from 2 to 3.5. So not a company that is highly profitable. I will say I just took a peek on fiscal.ai. My vote would be for phase 3. But, so I'm curious.
All right, that's a new one. It's saying try again.
Oh, you got it on Flash? That might be part of it. Huh. I've never seen Gemini even offer those up.
Yeah. Let's try that. Let's try that again. If not, we can just figure it out manually. No big deal. But it is nice when we can go to the AI and have it do some of the work.
Well, that was it's showing up as Flash on mine as well. So that's a new change that they made for
here we go
for everything.
All right. This says phase 4 operating leverage with a high degree of confidence. Operating income is apparently positive. So 175 million in positive revenue growth, 90%. Capital returns, no specifics, no dividends, no buybacks, or anything like that. Therefore, forward numbers make sense. That means that seems logical to me. Look at all the forward numbers for this valuation. So they're capitalizing on explosive data center and AI infrastructure demands by scaling production. This stage proves the underlying business model is highly scalable Revenue is rising quicker than operating overhead, turning previously unprofitable operations
Yeah.
into a cash generator. So this
It's
company
gonna
just
help.
recently faced.
It's going to help to look at this because I just looked at it on fiscal and just
Okay.
pull up the operating profits. Just do that because I think that'll show you how cyclical this is.
Holy
I mean,
cow,
look at
Batman.
that.
Yeah.
I don't know. Can you even pull it back just to see what it looks like over? Yeah. So to me, this is a very highly cyclical, historically
Yes.
company.
Key point. This is a highly cyclical company historically, where you can just see how profitable, unprofitable, boom, bust, boom, bust. And these are all during periods when the overall economy was doing pretty well, right? So 2021, huge profits. And analyzing companies like this is just harder. It's just harder because valuation is more difficult. What is the quote unquote normalized profit level for this business? That's hard to know. Now, we saw last week when we looked at SanDisk that it was a boom and bust, but the business had transitioned to a higher quality revenue, was transitioning to higher quality revenue, which in theory should smooth out this or even eliminate it. So I wonder if they're going to be in that same following in those same footsteps. But we do not see a dividend here. And since we're on the financial page, let's also check in on I'm guessing revenue is crazy cyclical too. Revenue is less cyclical. That's surprising.
I bet if you pull up the growth rates, it might tell a different story.
Growth rates.
Yeah, right there. You know, so it did go negative in the fiscal 24, but man, has it shot up since then. It's like a
look at the growth rate. Just skyrocketed. Finally, we take a look at diluted shares outstanding. And
that's increasing.
Wow, look at that. Low and then up and then low and then up. But yeah, if
got to be acquisitions in there,
I would say phase 4 operating leverage is the most likely candidate here, with the caveat that the diagram we have here assumes kind of like smooth things. This company is anything but smooth. So you just got to play with that and kind of adjust as we go. Hence why analyzing companies like this is just a little bit harder. So I'm going to go with phase 4, the operating leverage phase. Next step, what does this company do? So let's look at its key products, who its customers are, and then some business quality aspects to it. So I have my business analysis prompt here. Go to Gemini, type it in, and we will start reading. LITE.
There we go.
Lumentum. And this is when we get to learn more about the business. It still has flash on. I hope that's
that's how it was for me too. It seems like it's a permanent change that Google has made.
Okay.
All right, here we go.
Leading provider of optical and photonic products. The company manufactures advanced optical components, lasers, subassemblies, and transceivers that enable the transmission of vast amounts of data through fiber optic networks and data centers. Its technology acts as a physical backbone for cloud infrastructure, telecommunications, artificial intelligence, processing clusters. Okay, so optical components, lasers, photonics, and receivers that allow data centers and technology to talk to each other. Okay, how does it make money? By revenue, by selling hardware products categorized by architecture type. Lumentum historically manages business via cloud and networking and industrial tech segments. It officially reorganized into a single reportable segment during Q1 of fiscal 2026 to make its operations a unified enterprise. So it used to give segment readouts. Now it's just all one clump, jumbled together number.
Interesting. Okay.
So from the most recent quarter, which was in March, revenue is broken down by product types. Components, 66% of revenue. Specialized building blocks, semiconductor laser chips, which are called EMLs. Laser subassemblies and Coherent. Coherent used to be a publicly traded company, I believe.
It still is. They're just saying coherent. They're just using the normal word coherent.
You're right. It is a lowercase c. Supplied to clients who integrate them into broader networks. Systems, 34% of revenue. Complete operational setups, heavily driven by surgical optical circuit switches designed for hyperscaling cloud data centers. I'm guessing this is the one that is exploding. Let's go to fiscal, reportable segments and KPIs. Do they break it out?
Well, just over the last 12 months, that's it, because they just started doing that.
Yeah, so we don't have.
We don't know
The company just started doing this, so they obviously can't go back beyond that. Well, here are the old reportable segments, right? So cloud and networking growing modestly. The industrial red tech was declining. This was actually a declining business. Yeah. So you can see how them changing the reportable segments. Okay. This is earnings before tax on each. Cloud network is the driver and other EBT. Okay. So a company in transition from a reporting perspective makes things a little bit more difficult. So components and systems. And systems, I'm guessing, is the big growth business. Who are the customers? Primarily made up of cloud hyperscalers,
Amazon, Azure, Google Cloud,
original equipment manufacturers, and network equipment manufacturers. In March, Lumentum deeply solidified its enterprise cloud base by completing a massive private placement of $2 billion of preferred stock with NVIDIA. That sounds like a big deal, highlighting its role as a critical partner in AI hardware infrastructure. So NVIDIA did a private placement worth $2 billion in preferred stock. So NVIDIA is now a decent-sized shareholder of Lumentum.
Yeah, it's probably somewhere in the ballpark of maybe, depending on where the stock was in March. I mean, that could be as much as 5%.
Yeah. So, okay, which would be roughly in the line with what you'd expect for an investment like that.
Yep.
And where does it operate? Highly diversified, manufactures products and shipping them worldwide. The vast majority is international. So international markets are 80% of revenue, Asia and Europe, and the US is about 19% of total revenue. All right. Got the gist of the business. Now let's get into the details. How frequently do its customers buy? Buying patterns are historically cyclical and non-recurring. A key reason why I would not be interested in this stock a year ago or 2 years ago or 3 years ago, tied directly to infrastructure build-out projects, multi-year component design cycles, and networking capacity upgrades. However, the business model is shifting towards long-term visibility.
Does this sound familiar from last week?
It sounds exactly like SanDisk, which is something the market loves. When you go from, hey, our business is cyclical to we're becoming more predictable, the market goes bananas for that. Lumentum secured major multi-year purchase agreements with hyperscalers. Management recently locked in a multi-billion-dollar recurring purchase agreement with a primary cloud customer. Okay. So historically, cyclical, although really it wasn't that cyclical. It wasn't like crazy cyclical. Profits were very cyclical, but revenue is actually, right? Let's just look at revenue for a second. Now there's a color choice. Like, that's not crazy cyclical to me. It is cyclical. Like, obviously there was a downturn here, but not nearly as bad as you would expect.
Yeah, it was in the profits. Like they could not cut their overhead when that cycle turned against them.
Well, let's take a look at gross margin, because that will actually tell us quite a bit about Okay, so this is gross margin, revenue minus cost of goods sold, and look at this is a far more cyclical number. So, although, wow, it was really increasing here, their gross margin almost hit 50% before diving to 24%, rebounding to 41%. So, okay, it's not as cyclical as I thought it was going to be. I would thought that they would be giving pricing concessions, which we would see in the gross margin to juice revenue. And you would see.
Well, they don't need to right now. I mean, this is the same thing we saw with SanDisk. They are in the driver's seat. When you have water during a drought, you make the rules.
Yeah, for sure. Okay. Can it raise prices? Yes. Currently commands significant pricing power due to structural supply constraints. Demand for its optical infrastructure is outpacing their current factory capacity by 25 to 30%. Customers are rushing to allow scarce supply. Lumentum does not have to heavily discount. Allows gross margin to expand drastically year over year. They're in the driver's seat, just like you just said. Finally, what happens in a recession is highly cyclical and vulnerable to macroeconomic downturns. During periods of economic contraction, Network equipment manufacturers rapidly slash orders to preserve their own cash. This creates severe factory utilization, dropping profit margins quickly. Just a year prior, macroeconomic headwinds and inventory corrections pushed Lumentum into severe operating negative losses. So there's the business. There's a little bit about the business. So the company makes optical equipment that helps data centers and stuff talk to each other via these lasers. Historically, highly cyclical. More recently, it's become a little bit better. Now that we know a little bit about the business, would love some feedback from the viewers here. If you were to rate this company on a scale of red, I'm confused, don't get it, to green, I'm excited, this is a business I want to know more about, put in the chat what rating you would give this give this company right now.
While folks are doing that, let me just say that again, this is just like last week, where if you understand, you've played in this industry, you get it. I totally get, Bob saying green, another green, like a whole lot of greens. To me, just for me, this is like trying to run across an interstate where I don't know what's happening. Boy, does it seem really good right now, but I don't know what I don't know. So I tend to come in more where like Mimi and Walt and Klaus and Scott are and say yellow, not through any fault of the companies. It's handicapping for my own lack of experience.
I'd go with there. I'd go with there as well. I mimic everything that you just said. There's definitely reasons to be excited about this business, especially with the growth I think we're about to get into. But I would just go with yellow, looking at what we've seen historically, personally.
Yeah.
Okay. Next step is the company's Moat. So Moat. There are 5 potential sources of Moat: network effect, switching costs, low-cost producer, intangibles, and counter positioning. 3 possible Moat states and 3 possible Moat directions. Would love to know from the viewers which Moat source, if you think this company has one, do you think is working for the business right now? If you had to identify one of these Moat sources, which do you think that it is? While we're waiting for those answers to come in, I'm going to go to Gemini and put this in and see if this company has a Moat, what AI thinks the size of the Moat is, and most critically important, what direction the Moat is heading in. I think I know the answer to the third one there. Okay.
Yeah, I think I do too.
Narrow Moat, widening, switching costs, and intangible assets.
Intangibles, that's what most of our viewers said.
Intangibles?
Yep.
Makes total sense. Yeah, you're going to have to prove to me that they're switching costs. Lumentum possesses a narrow moat driven by deeply integrated custom hardware co-designed with hyperscalers. Okay.
This is what Brandon just said. The data centers aren't going to rewire their entire infrastructure once they get started.
And if it's co-designed with them, which I'm guessing would be part of that NVIDIA deal that we saw.
Right.
That it absolutely would create switching costs.
Right.
Immense technical IP and high-speed optical connectivity. The structural strength is verified by gross margin expansion, showing immense pricing leverage. Okay, switching costs. Lumentum products are deeply integrated into the architectural roadmaps of massive cloud data centers. Its proprietary optical circuit switches and ultra-high-speed transceivers are hardware validated at the silicon level alongside major AI chips because cloud infrastructure operates under multi-year architectural rollouts. Switching provides costly deployment delays, structural reengineering, and physical network downtime. So narrow, but widening. Okay, I totally buy that. I totally buy narrow and widening.
Yep.
All right. Demand is up 40%. The components remain effectively sold out for their foreseeable future. And
again, this is memory. This is memory right here.
Yep. Intangibles, narrow and stable. High speed, highly specialized proprietary semiconductor manufacturing processes, particularly its indium phosphide wafer fabrication, produce state-of-the-art electro absorption modulated lasers. Acronym soup. This company loves acronyms. Competitors cannot easily duplicate them, given the company's exclusive hardware design advantage. TechMoat is heavily backstopped by strategic capital commitments from sector anchors like NVIDIA. I mean, the NVIDIA equity investment and preferred stock is definitely a massive vote of confidence from a company that knows what it's talking about.
Yep.
So its EML chips grew 100% volume. R&D spending is up, and our ultra high powered laser chips manufactured for CPO is proceeding according to plan. We achieve sequential growth. All systems go. Network effects, nope. Low cost production. Okay, this is interesting. While they're producing rapidly with specialized manufacturing hubs in Thailand and North Carolina, it does not possess a structural cost advantage. It's exposed to volatile input costs, high capital intensive, and technical yield curves. The temporary margin expansion is driven by extreme supply shortages and pricing discipline rather than lower baseline cost than peers like Coherent. So Coherent is a major competitor.
Let's just talk about this for 1 second, because this is really important. So what I'm reading this as saying is that Coherent has a structural cost advantage. Let's just assume that's the case. So then you might be wondering, well, why is it Coherent's up a whole bunch too, but I don't think it's up as much as Lumentum. So you might say, why isn't it up as much? Well, you got to think about this whole process. If Lumentum doesn't have a cost advantage, that it's going to trade for lower on a valuation basis than Coherent. That just makes sense, right? And they're both going to go up, but Lumentum, you would imagine, is going to go up even faster because it was starting from such a low point. Does that make sense?
Right. Yeah, absolutely. And just from a size perspective, this is a $63 billion company. Coherent is a $70 billion company. And if we were to say, look at Coherent's revenue by comparison, $6 billion in revenue. I think Lumentum was under 2.
Mm-hmm.
So their margins about similar. Okay, good to know. Yes, I would say that it does not have low cost production compared to just Coherent. Yeah. And then counter positioning, it does not have a disruptive business model. Risks.
Yeah, go ahead, because then I have one other thing I want to add to this.
Customer concentration, market share battles with Coherent and Corning.
Mm-hmm.
And then Morningstar. Morningstar says narrow moat stable, and however, it adds crucial nuance by demonstrating a widening near-term path due to the highly sticky multi-year OCS and NVIDIA preferred. Yep. So, all right, voting time. Sorry, you wanted to say something?
Well, people can vote. So vote. Let us know what you think of the moat. Red, there's no moat. Yellow, it's narrow. Green, it's widening. But while people are voting, Brian, I put a link to a tweet that our friend Travis Hoyam put out recently. I'm not sure if you can click on that and pull it up. If it's too much, I totally get it. But he brought up a really interesting point recently, talking about the speed of competition entering the AI value chain. Because what his point is that, like, right now, Lumentum is where NVIDIA was 3 years ago. Now, this doesn't mean NVIDIA is dead in the water by any means. It just means look at how quickly alternatives come to the fore.
Yeah. Right. This is the whole reason for when you see a gold rush. Yeah. Well, this is the whole what's the cure for high prices?
High prices.
What's the cure for low prices? Low prices. There's a gold rush in this category right now. And the question is, does the company actually have a moat that prevents competition from coming in? But Travis, I think, does bring up a really good point. Anyway, if I was to pick one, I know what I would pick. What are people saying?
Largely a lot of yellows. Yep. But the people who go into a little bit more detail are kind of zeroing in on the thing that you've really focused on, I'd say, over the past 6 months, which is narrow, but it's hard to argue that it's not widening given the longer term aspect. Like, they can't just pull these out. If they're co-designing things, once you start co-designing things, that's a widening moat.
Yep, widening, which is the critical thing.
So it's like a yellowish green. It's
yellowish
narrow,
green. Yep.
But it's also widening. Also, Brian, just worth pointing out, it's why in Stock Simplifier 2.0, which we'll talk about in a minute, we make you give a rating both for the width and the direction.
Correct. We think this is absolutely critical. Width and direction should be separate things, scored separately, because you might have no moat but widening, or a wide moat that's narrowing. Completely different businesses, completely different investment cases. All right. Next, long-term potential. Do we think that this company can grow, or what are the growth drivers that we should understand for the business? I'm going to go to fiscal. So our shorthand to figure out growth potential is just to go to fiscal, go to the overview page and scroll down. So this is a company that has grown revenue 20% over the last 3 years. Earnings have grown about, they've doubled. Don't read too much into that, the cyclicality, but what do the forward numbers say? Revenue is expected to grow 83% per year. Earnings are expected to grow 500% per year over the next 2 years. And the long-term earnings per share growth rate, which I usually read is 5 years roughly. Analysts think this company's earnings are going to double every single year over the next 5 years. Actually, let's take a look at that. If we go to revenue,
that's 32x. That's 2 to the 5th power.
Here's what Wall Street thinks is going to happen
in
2026 and then 2027. That's revenue. And if we go to earnings per share, look at that. Earnings per share are currently, what's that say? $5, and then $8, and then $18. Now is what is what Wall Street thinks is going to happen.
For what it's worth, and I only have this because I have the fullest of the full versions of Fiscal AI that I pay for. So you said it's supposed to go to $18. The year after that, it's supposed to go to $28.
Which makes sense. That's why the growth numbers were astronomical and eye-popping. All right.
And for what it's worth, in 2028, their revenue is supposed to hit 8.3 billion.
Wow.
From 5 to 8.
Wow. All right. Let's understand the story between how does the company do that? What is the growth drivers there? Okay. Is the company going to get sales and marketing investments? It says sort of. This isn't really a spending problem. I'm guessing that there's pluses and minuses to every business strategy. This company's business strategy is sell to the hyperscalers. That really keeps your sales and marketing costs low.
Yeah,
because you're only going to a couple of customers. And more growth doesn't require huge investments in sales and marketing. The downside of that is the concentration risk that comes along with that. But I don't think major investments in sales and marketing are needed. So I agree with there. New distribution, not applicable. It's kind of got its distribution in place. Okay. Geographic and market expansion, strong. They're aggressively localizing and expanding the production footprint. We saw that they had that facility opening up in North Carolina, I believe it says. The company is expanding its high value factories in Thailand and hosted a grand opening for a state-of-the-art semiconductor footprint in the United States. So geographic expansion. Acquisitions, strong. To absorb the sheer volume of AI optical demands, Lumentum completed the acquisition of Greensboro wafer fabrication facility. It's actively converting the site from old gallium arsenal into the new one to scale up production. Okay. Is that an acquisition? I guess so. It's a facility acquisition. It's not really a company acquisition. Can the company raise prices? Yes. Very strong market demand gives the company virtually eliminated discounting so they can charge full prices. Huge jump in gross margins as a result. New products. The ramp to the next generation hardware architecture is a massive growth driver. Shipments of the narrow line width laser assembly grew 120%, and shipments of its electric absorption modulation, its EML lasers, doubled. Customer retention, very strong. They have locked in their core customer base through multi-billion-dollar agreements. Finalized the massive $2 billion and multi-year strategic partnership with NVIDIA. And then, all right, so overall, new products and services. It's creating products that are specifically for machine learning and AI. Makes total sense, responding to the market demand. Pricing power, it can raise prices. Secondary growth drivers are the new facility that has unlocked and the geographic expansion. new distribution channels. So market expansion, I would call acquisitions yellow.
They acquired fabrication capabilities.
Okay. It was an acquisition in their own marketing, distribution and production process. Okay. Well, I think I know how people are going to vote on this one. Does this company have long-term potential? I'm just going to go out on a limb and say, yeah, this company has significant long-term potential. And the market is clearly pricing in that demand will outstrip supply for at least a couple of years, which is just going to explode profitability. All right, next, key metrics. So the key metrics that we look at change depending on the phase that the company is in. This is a company that was in phase 4, operating leverage. So we have the AI programmed here to look up different operating metrics and then judge them based on what phase the company is in. Let's go ahead and enter that prompt. And it should ask what company, and I'll say LITE phase 4. When it comes back. Okay, it knew that already. Phase 4. All right. So first thing to look at is revenue growth over the last 3 years. We want to see this number over 20%. And when we were looking it up before, it clearly said over 20%. So that was definitely correct.
It maybe trailing it wasn't, but we know that's where it's going.
And that's absolutely right. Next thing we look at is operating margin. We want to see that this number is just positive and rising. It's definitely in an uptrend right now. So that one is definitely a green. Next, we want to see free cash flow margin. This says negative.
Yeah, let's check that.
Let's double check that. Okay. So
I could understand if their capital expenditures are through the roof. If they're building out their production capabilities.
So let's just look at free cash flow on a raw basis.
Yeah, I mean, it's barely positive. 114.
Barely positive. 114 million. That's definitely well below its profits, but actually this number looks a little bit more resilient than its profitable. I mean, definitely historically cyclical. Look at this. $1 billion in free cash flow. 1.4 billion is expected in next year, and a little bit of growth here. While we're here, let's also let's look at stock-based compensation. It's growing. Don't love to see that, but not all that surprising. And then how about capital expenditures? Is this number just exploding?
It is.
Probably, yeah.
So I mean, that free cash flow kind of, if you take the free, so that tells I think a clearer picture. But yeah, it makes sense.
Makes total sense.
Trying to meet demand.
They are investing in their own capabilities. Okay,
Brian, before we finish this, I do have a question for you because Bob brought this up before. We're talking about the next 2 to 5 years, and we don't know about the moats after that. That doesn't feel like long-term investing. However, it's also been incredibly profitable investing, and that could continue. How do you think about that?
Totally depends on the type of investor you are.
Yeah.
Right. This is a company that historically it's been really hard to predict what's going to happen more than a year out. I think that with the business model shift, it's getting easier to predict, say 2 to 3 years out, but going beyond that, it's going to be very hard. We're going off the numbers that we see. If you're going to be making investment for the long term, which is the kind of investing that we do, you're just going to have to be willing to ride out any future cyclicality if you want to do that in the long term. These are not companies that I have invested in historically, and I personally don't invest in any cyclical companies in my portfolio. But this is why we do the research ahead of time. Curious how you think about that, though.
I've never seen anything quite like this. Like, I've never experienced anything like this. I wasn't investing in the 90s. I was a middle school and high school student. That's the only other real, like, N of 1 in my lifetime to look back on. And so it's really hard for me to know.
For years, I was invested in a company called Form Factor, FORM. I wonder if they're still, look at that. They're still publicly traded. And this is a very cyclical business that makes testing equipment for semiconductors. They're a key part of the semiconductor testing and validation process. I wonder what's happening with their revenue. Yeah, I invested years ago in this company, and I lost money on them. So I'm guessing this is a stock that if you look up here, it was just, yeah, gut-wrenching cyclicality and then AI. So with companies like this, if you're going to invest in cyclicals, the timing of entry definitely matters. Definitely matters. All right, continuing on here. So we saw revenue growth over 20%. Operating margin is positive and rising. Free cash flow margin is positive and rising. How do they do with earnings versus estimates? I got to go back to LITE. Let's go ahead and go to estimates. And let's take a look at quarterly for earnings per share and see how they've done. Let's look at the A's. So estimate, actual, beat. Man, this is a company that like, oh yeah, right here it says it. Every year, every quarter for the last couple of years has beat. Always love to see that. And then finally, return on invested capital. We just want that figure to be positive, and rising. I'm guessing we're going to see if we go to financials, we go to ratios, and then we scroll down to
financial efficiency, I think.
Capital efficiency. Hold on one sec.
Doesn't want to close on you.
Yeah, I know. I clicked it too many times. That's why. Capital efficiency. And then, yeah, you can see that this number is all over the map, but more recently it is positive and rising. So good times, bad times, good times, bad times with this number, which is a trailing number, to be fair. But I would say positive and rising at least recently. So key metrics for this business, all looking really good, trending in the right direction. Next, risk. Let's take a look at risk. And oh boy, should this be a fun analysis to do?
I don't know. I think this one might be really low. Do you remember SanDisk was really low last week? Because look, if your products are spoken for over the next 2 years, right, obviously there's risks, but I don't even think they're execution risks. I think they're just other options coming online and supply eventually meeting demand.
Let's read. So AI says high risk, high execution risk. Why? Because of severe customer concentration and extreme capital disruption cycles. But they're multi-billion-dollar co-design agreements and exclusivity with NVIDIA and primary hyperscalers. Okay, concentration risk. 2 hyperscalers were 26% and 12% of total net revenue. I'm guessing NVIDIA and somebody else.
Yeah.
Creating a total top 2 concentration of 38%. This was up from the year prior.
So it went from 32
definitely you're
to
taking
30...
on customer concentration risk.
8.
Disruption. While Lumentum acts as a technological enabler for high-speed AI via its new platform, it faces structural product obsolescence cycle risks. Failure to capture the upstream structural shift towards co-packaged optics for silicon photonics could disrupt its core transceiver module business.
This is where I don't have any, like, I have not played in this. I owned IPG Photonics for a long time, many years ago, and since then have not played in this. So like I read that and my eyes just kind of gloss over, and I'm like, this is in the too hard pile for me.
Yep, you got it. You have to understand the disruption potential for this business, which AI is definitely flagging for us. Outside forces, red, and this is a big problem. Highly exposed to structural hardware supply chain constraints and manufacturing bottlenecks, currently operating an extreme undershipping dynamic where it must pick which buyers receive scarce pump laser allocation. 81% of its shipping destinations are international, creating intense geopolitical and international trade regulatory vulnerabilities. Yeah, the big outside force here is just cyclical market demand, or at least historically that's been it. Yeah. Competition risk, red. The advanced optical photonics is creating hyper competitiveness. Coherent matching its Coherent received a matching strategic investment from NVIDIA and is aggressively ramping its 6-inch indium phosphate wafer architecture. If peers close the yield gap on its next generation later, Lumentum's scarcity-driven pricing power will rapidly compress.
Right. Right.
So
That's
NVIDIA
the risk.
did not
And
make.
you've got to know whether or not that's around the corner. Like, one of the reasons I love investing in Amazon's e-commerce is because I can walk outside and see those vans. I can drive and see the fulfillment center. And I'm like, you know what? I will see it coming. If someone, like, I'm not going to see this coming. Me, others might be able to. I'm not.
Let's take a look at the things that could buffer these risks. Because production lines are severely gated by supply chain capacity limits, the company is forced into rotate hardware to its small, highly concentrated customer base. It's got big customer concentration risks, but it's liquidity. Okay, it's got plenty of liquidity, $3 billion in cash, contractual visibility, locking in multi-billion-dollar long-term purchase agreements for its line, targeting $1 billion in annual recurring revenue for product line alone by 2027. Okay, so it's shifting its model more towards these purchase agreements, which have quote unquote guaranteed revenue that's more recurring in nature, and it's got a strong cash buffer. Wow, how are people going to go vote on this? So red, yellow, green. What do you think is the execution risk here? The numbers that we showed you before with Lumentum, right? The growth that needs to happen for this investment to pay off. What do you think is the chance that growth, the riskiness of that growth appearing? Do you think red, very high risk situation, yellow, it's a medium risk situation, or green, it's a low risk situation?
We're getting some uniformity in our first couple. Let me just say, I kind of love Brad has been in here talking about how this is the next big thing for AI infrastructure trade. But what I love is he's got his eyes wide open. He's saying, look, the risk is definitely red. That's great. And that doesn't mean it's not investable. It just means you got to understand that before you put your own money behind it.
I'm going to go with red, but if I was given 5 options here, I would go with what a lot of people are saying, reddish yellow. Yeah, it's more of an orange than a red or a yellow. The company has the infrastructure, the orders, and the demand. It just needs to work on fulfilling that. There are some outside forces that could prevent that from happening, but I would say over the near term, that's not that big a risk. What is a bigger risk worth thinking about is if the company is making all these investments in capacity and for whatever reason, the demand dries up even slightly. This is a company with tremendous operating leverage in both directions, right? So you could see if the company has to give in on pricing to get orders done, or if there's any sort of glut oversupply, you could see profitability rapidly disappear. It seems like it's taking actions to mitigate against that, but it is worth something keeping in mind. All right. Next, valuation. Boy, is this one going to be hard. Because valuing cyclical companies is just tricky. As we saw with SanDisk last week, if you were here with us, none of the valuation numbers looked crazy. They all looked reasonable. The question is the denominator in all of these multiples accurate and sustainable, or is it in a temporarily inflated number? But either way, let's take a look at some numbers for this business. So the metrics to look at are all going to be forward numbers. So if we go to ratios, we don't want to look at trailing numbers. We want to look at forward numbers. They're going to be more in line given the company's growth rate. And let's start with price to earnings. All right. So this is a company that usually trades at
the teens,
low teens. I would say that makes sense given the cyclicality of the business. And then more recently, it trades at about 56 times forward earnings, 56 times.
And that's forward earnings.
And that's forward earnings, correct. If we look at free cash flow, I'm guessing we're going to get a similar number. So here's free cash flow, 56 times
it's about
forward free cash flow. Keep in mind, free cash flow is expected to explode Historically, this number is in the, again, low to mid teens is kind of where it is. Since we're here, let's take a look at forward price to sales. That might give us a cleaner look because that number is less impacted by the cyclicality. Historically, between 2 to 4 times sales, currently 12 times sales. 12 times sales.
I'm curious, what about price to operating cash flow? Or you can do forward EV to OCF. Just have OCF in the denominator, whichever one you want. I'm just kind of curious to see what that would show. Okay.
Similar story.
It's all basically the same. Teens to 50s.
Yes. The market is pricing this company for extreme growth, and that is shining through in the valuation. A notable change from last week. Let's just quickly pull up SanDisk this is the company that we did last week. Very, very similar story. And if you looked at any of the forward numbers for SanDisk, they were all much more palatable on a forward basis. What did I just click up? Oh, that's earnings yield. Click the wrong button. Let's take a look at forward PE. This is a single digit number. So SanDisk trading at 8 times next year's earnings. Lumentum 50 times next year's earnings.
That's a really interesting disconnect right there.
That really is. Red, yellow, green. What do you think of the valuation today? Green looks cheap, attractively priced. Yellow, moderate, or red looks quite overvalued given the numbers that we see here. Tariq asks about a DCF. I would say this is a pretty poor company for a DCF because the DCF, you have to put in your estimates about the growth rate and then your terminal growth rate. I would have a very hard time estimating the 5+ year growth rates for this business. And then also what kind of discount rate do you use?
What would you think about a reverse DCF?
Reverse DCF, that might be more appropriate.
A little bit better.
Oh, definitely. I always prefer reverse DCFs to DCFs. Oh yeah, reverse DCF, Tariq. Yeah, absolutely. Different story. I don't have one of those handy.
Boy, but even that is tough. Let me just say that even if we do reverse DCF, their free cash flow margin in good times can be as high as 40%, and in bad times as low as -10. So I mean, everything depends on what you choose. I would probably choose something like maybe 10 or 15%.
Yep.
To do that. Yeah.
Our good friend John Rotanti, who is a fabulous investor, he focuses a lot of his mental energy when he's analyzing companies like this are what are sustained, cyclically adjusted margins. What is the number that you should put in if you averaged out the highs and the lows, and that's like the actual cash generation ability of the business. So you have to kind of knock down the peaks, increase the valleys, and pick a number there. For a business like this, 10%, 15%, something in those lines, maybe.
Look, I'll tell you, I just did it real quick. If you assume that Lumentum has a 15% optimized free cash flow margin, which again is very tough, it goes from 40 to -10. So 15 is just kind of like, well, let's split the difference. If you do that, then revenue needs to grow by about 38% per year for 10 years.
How?
38% per year for 10 years. I forget what it's supposed to grow by over the next couple.
It's going to double effectively every year for the next 3.
And this is what's so hard about cyclical companies, because then what you're basically saying is, I'm just going to pull a number out of my head. From year 4 to year 10, it probably needs to grow on average 20%. But again, that on average, it really depends on how high those highs get and how low those lows get in years 4 through 10.
Yeah.
It's really hard to do with this.
Over that long of a time frame, you have to assume competition comes in. There's another pattern of disruption with the company's product cycle that it has to navigate, right? So, over a 10-year time horizon in the semiconductor industry, that might as well be infinity. Right? There's so much that can change. That's so much that can change in there. Okay. Next, let's take a look at the sentiment analysis. I have a feeling we're going to know what the sentiment says, but let's go ahead and throw this in. This does a check to see what do analysts think of this company? What do Wall Street think of this company? What does the media think of the company? What is the company? What's being said about this company? All right. So over the last year, the overall takeaway, Lumentum's stock experienced a massive rally due to exploding demand from cloud hyperscalers for its advanced interconnect components, where critical positions. Oh, the primary drivers were critical position in Google's TPUs and NVIDIA's GPUs computing supply chains, capped by a massive $2 billion strategic investment from NVIDIA. So I would guess that customer number 2 is Google.
There you go.
The next catalyst is in August when it releases its fiscal Q4 earnings. And the outlook, while the operational expansion and massive backlog provide strong fundamental support, the stock's 11% 100 gain has severely expanded its forward valuation multiples, leaving little room for execution missteps. But the overall sentiment here is definitely bullish. The NVIDIA Street partnership, the benchmark index inclusions, was added to the S&P 500 and replaced CoStar in the NASDAQ 100, forcing heavy institution and passive fund accumulation. So it's now in the NASDAQ. The bulls say, take a look at the backlog, the explosive revenue acceleration, and the INP footprint expansion. The bears say the valuation multiples has gotten ahead of itself. The customer concentration is very high, and the execution risk here is very high. For what it's worth, it's been a massive outperformer and all that stuff. Always good to see that. All right, so the sentiment, there you go on that. I also want to show you in the new stock simplifier, we have a prompt here that analyzes the management team. So let's take a look at the new stock simplifier and take a look at the management team. So this rates management a 3 out of 5. Management is in transition. Alan Lowe retired in February after 18 years, and Michael Hurlston just took over as the AI optical super cycle hit. 14 months is too short of a time period for a high rating.
Prudence.
Yep. So he's new and he's proving himself. The Finistar pedigree is relevant. Hurlston ran Finistar through its sale to 2.6, which is now Coherent. So he's a CEO with a track record, and he has 2 years of operational pain. The handoff came with real execution scars. The mixed ratings on Glassdoor, they do beat expectations. To me, that matters a lot. And this CEO has definitely exceeded expectations in every quarter. Are they shareholder friendly? Sort of. And the margins are okay.
Hey, Brian.
Yep.
I'm just kind of curious. I'm going to put in the chat where people can go to sign up for this at longtermmindset.co/waitlist. Is it possible to click on that Moat tab to just see what our stock simplifier said? I don't want to mess it up.
Yep.
All right. So it was very similar to what we talked about, narrow but widening.
Narrow Moat. It's the only 200G EML supplier. Intangibles and Chinese competitors dominate receivers, but limiting tier. So it's a top tier one. So it doesn't compete in commodity components. It's a top tier component, but the Moat is widening. AI CapEx concentration at the base layer. Margins are growing, the NVIDIA lock-in, and capacity investments. So the new stock simplifier said, Moat, it's narrow, but man, is it widening. So very similar to what we
breakdown of each 3 of those, because it called out, what was it? Switching costs, intangible assets, and counter positioning.
Yep. So you can see how useful the new one is with analyzing this kind of thing. Okay, taking it all together. We said that this is a business that is yellow. Some said green. The Moat is definitely narrow. It exists, but it's expanding. Great long-term potential. And by long-term here, it is worth caveating. We mean over the next 2 to 3 years. Longer term than that, it's hard to see. The key metrics for the company look outstanding. The risk here is worth highlighting. It's kind of a reddish yellow, and the valuation is very high. So what do you guys think? Red, nope, not interested in this business at all. Yellow, put it on my watch list. I could be interested at the right price. Or green, man, I want to get in on this business today. I would love to know what people think.
Robert said too hard pile. Santo said pass, but keep on the watch list. Got a couple yellows. Tariq saying no, you have to be 10 years old. Yeah. I mean, that's it. There's definitely risk involved. I will also point out, I always say this, position sizing. You know, you can give it a red and still make it a 0.5% position or a 1% position. Just something to keep in mind.
Yep. For me personally, I would rate this as no, a pass. Not because it's not an interesting company, but rather if I was going to bet on a company that, if I was going to bet on a company that was an AI supplier, I liked last week's company of SanDisk a little more. And it's a very similar story, very similar trajectory, but the very similar growth and all that kind of stuff. But the valuation was more compelling to me than this valuation here. I don't own SanDisk. I'm not going to buy it, but between the two, that would be my choice.
The big thing, honestly, the thing that I'm walking away from this with is I'm going to go look at Coherent, because that doesn't mean that I trust that the AI was right, that Coherent has a wider moat, but it put it on my radar. So, you know, might as well go look and see what similarities and differences Coherent might have.
There you go. All right. So the new stock simplifier, the one that we've been working on for months in the background, it officially launches to our wait list only our wait list on May 27th. So next Wednesday, 8 days. If you want to get on the wait list and be the one that has first access to it and a special launch price, just go to longtermmindset.co/waitlist. If you could share that in the chat. Joining the wait list is absolutely free, but you will get the chance to be the first to access it. We have been working for it on this for months. I mean, it has been like the bane of my existence to get this thing out. So we are incredibly excited to launch it for real. We have had a couple of beta users that have been using it for 2 months. We've been taking all the feedback that we get from them, fixing issues, redesigning it to make it better. I'm extremely proud of it, and I can't wait to get it out there.
You should be. It's really good. Bruce is one of the people who's been using it, uses it frequently, and I know because I'm old school. You got to pull my fingernails off to get me to change my research process. I've used it twice today, not including this video. So I think that's the ultimate vote of confidence, because I am stuck in my ways.
That was my North Star. If I get Stoffel to actually change his habits, that's a win. Because I know how hard that is.
Here's why it's so great. It eliminates ideas quicker. And that makes me use my time better. So there you go. That's my one pitch for it.
Well, thank you guys so much for joining us today. We will be back next Wednesday with another deep dive stock. Where we'll be researching a company from scratch. And May 27th, next Wednesday, 8 days from today, is when the new stock simplifier launches. If you're interested, join the wait list. Until next week, we'll see you then. Brian and Brian, out.